But let me get to this Fed survey, Joe, which is a dramatically different one from any that we presented since the pandemic began. It shows the market firmly forecasting the Fed will reverse course and begin to remove stimulus more quickly over the next several years. Here's the Fed expectations chart. 31 respondents thinking the Fed is going to announce tomorrow it will double the speed of the taper to $30 billion a month. The Fed's going to start hiking rates in June, according to this survey, and deliver 3/4-point rate hikes next year, 3 more in 2023. The Fed funds will rise to 2.3% by 2024. That's our first look in a while at the terminal rate. We haven't been asking about it. Here we are now. The funds rate now seen rising to 72 basis points by the end of next year. You can see there the sharp increase there. That's up from 53 in November, and then approach 1.5% by the end of 2023. Kathy BOSTJANCIC, chief U.S. financial market economist at Oxford, writes in, the Fed's discomfort with elevated inflation has risen, and officials are concerned the Omicron variant might exacerbate supply constraints. This opens the door to faster rate hikes that, if too rapid, could constitute a policy mistake. But wait, because others like Gorman argue that the policy mistake may already have been made, going too slow in removing stimulus. Steve Blitz of T.S. Lombard writes in, the economy has jumped far ahead of Fed policy rates. The only hope is to raise rates and hope inflation drops enough to bring everything into line. Here's the terminal rate. The Fed's seen hiking through May 2024, hits the terminal rate of 2.3%. Now, some in this survey were as high as 4% for the terminal, others as low as 0.5 point, highlighting the new debate about how far the Fed goes once the cycle starts. That will be gaming out every day now. It's just one of the debates that have begun as the market moves from gaming out the taper. Now we got to game out the first rate hikes since 2018, Joe.